So hello, everyone. Charles Sizemore here, and joining me is my co-portfolio manager, Mario Randholm.
Hi, hello to everyone.
So we're going to try to keep our prepared comments fairly short so that we have lots of time at the end for questions and answers. If you're not super comfortable asking your question out loud, no worries. There is a chat functionality where you can type your question in. We'll try to get to everyone's questions. If by some chance we miss yours or we don't see it, no worries. Just reach out to us after the fact and we'll make sure we take care of you. So let's get down to business here. So fundamentally, let's start with just two basic tenets of what we do. We look to consistently generate performance, and we look to protect capital under any economic environment. And that second point there is what I want to talk about most today. We know, and we strongly believe here, that we are on the cusp of a major change in the economic environment. And I could beat around the bush. I could sound like a Morgan Stanley, marketing piece of marketing literature, or I could just give it to you straight. So I'll give it to you straight. The market is in a bubble right now. It doesn't really matter what metric you look at. They all point to the same place here. And anyone who tells you otherwise is either not paying attention or they are delusional. Let's look at the S&P 500. It trades for 30 times earnings right now by any historical metric that is, by any historical comparison, that is expensive. It's one of the most expensive markets in history. Looking beyond that, if you look at the price to sales ratio, we're at about 3.3, 3.4. That's literally the most expensive market in history. Now, don't take my word for it. Bloomberg actually compiled this. Bloomberg took a composite of all of the stuff you learn in your first year of MBA school. The typical valuation metrics, price to sales, price to earnings, price to book value, dividend yield, all of that. They created a composite. And by their composite, this is still the most expensive market we've had in history, more expensive than the dot-com bubble, more expensive than the Roaring 20s, the bubble that preceded the Great Depression, more expensive than even the 2020, 2021 COVID, fear of missing out bubble. This is the most expensive market in history. Now, you've heard the expression, don't miss the forest for the trees. Well, don't miss the trees for the forest either. Remember, the stock market is a market of stocks. So let's look at an individual stock to really drill this point home. Apple. Not to bash Apple, it's a great company. I have a house full of Apple products, but Apple trades at about 36 times earnings. And get this, it trades for about 8 times sales. Now, 3.3, 3.4, the S&P 500 level, that's bubblish. That's crazy. Apple trades at a multiple that is more than double the overall S&P 500. Now, remember, again, not to bash Apple, but when was their last major innovation? When was the last time Apple came out with a real game changer? It was the iPhone, and that was about 18 years ago. We're coming up on the 20th anniversary of the iPhone, which again was the last time Apple really had a game changer. Yeah, they have their headphones, they have their iPads, they have products, and they're good, but none of them are hyper growth game changers the way the iPhone was. And again, that was almost 20 years ago, and yet Apple is priced as if it's still a fast growing tech dynamo. So beyond that, just beyond the numbers, let's get kind of touchy-feely here for a minute. Think about your interactions with your friends, your neighbors, your coworkers. Think about conversations over the water cooler. There's no fear in this market right now. They say that stocks, climb that wall of worry. Well, there's no worry right now. There's no fear. This is a very complacent market. There is this perception that dips should always be bought. The market always comes back. There's, why sweat it? There's no fear. Whenever you see a market in which there's no fear, you should be fearful. What was Warren Buffett's quote? It's the most famous quote in history was, "The secret to my success is I'm greedy when others are fearful, and I'm fearful when others are greedy." Well, what we're seeing in this market right now is extreme greed and an absolute lack of fear. That should immediately put up, your, spidey sense, if you will. That should immediately make you cautious. Now, what is all the optimism about? We know it's really not a secret. It's artificial intelligence. It's AI. And let me start by saying I'm a fan of AI. I'm a believer in it. I use it daily. I use it multiple times a day. In fact, it's been a massive labor saver for me. It's really changed my life. That said, we are already reaching some of the limitations of the technology and we're hitting technological and financial brick walls. Let me explain what I mean by that. So the expenses of developing AI are growing at an exponential rate, whereas the benefit, the improvements, each iteration, each generation of AI, the improvement you're getting is incremental. It's improving a little, but your costs are soaring by a lot. And let me put numbers to that. The first iteration of ChatGPT came out in 2019. It cost a couple $100,000. That's it. It was essentially free to develop. The most recent iteration, which came out in August, cost over $1 billion to make. That's what we've managed to piece together. OpenAI has never actually released the real price tag. It could be significantly higher than that. Now, what's the next iteration going to cost? It comes out a year from now. 10 billion, 100 billion, who knows? But whatever you think it's going to be, you should probably add a few zeros to it. Now, meanwhile, the improvements from it, it's debatable whether there actually are improvements. This last iteration of ChatGPT that came out was a bit of a flop. In fact, OpenAI actually had to do an embarrassing climb down where they made GPT-4 available for a while. Like they had planned to phase that out. They actually had to bring it back due to demand. And I can vouch for this. I told you I use it daily. Most of what I use it for is just administrative stuff. But I was writing a piece recently, and I just needed a quick illustration of the time value of money. I needed to illustrate what $1,000 invested today at an 8% rate, what would that be worth in 20 years? Simple math, you can do it on a financial calculator in 30 seconds, but I was in a hurry, so I wanted to see if ChatGPT could do it for me. Great, hit the button. I got an answer that didn't quite look right. So I get out my calculator and I check, and sure enough, the answer that spit out was wrong. Why? Why did ChatGPT whiff on that? You have to understand how artificial intelligence actually works. Artificial intelligence isn't actually intelligence. It doesn't think. What it does is it imitates. ChatGPT approximates, imitates what it thinks a correct answer might look like. And so what it gave me was an answer that looked like it could be plausible. It looked like it, the time value of money might be something close to that, right? But it wasn't exact. Now, in my case, no harm, no foul. I recognized the problem and fixed it before it became a problem. But imagine if you're doing something that's high precision. Imagine this is a legal case. Imagine that you're preparing, you're looking for legal examples, and the thing hallucinates and invents cases that never existed because they kind of look like a case that could have existed. Well, that's a problem. And this is one of the limitations we're coming up against as the costs accelerate. So let's actually talk about some of those costs. $1 billion is, what was the old quote from Bunker Hunt back in the 70s when he lost his fortune? $1 billion ain't what it used to be. $1 billion really isn't that much money in the grand scheme of things. But when you look at the four hyperscalers, Microsoft, Amazon, Meta, that's the Facebook parent company, Google, they've spent over $100 billion in just the last 3 months building data centers. Over the next 12 months, that's expected to balloon to about $500 billion. That's the T, $500 billion. Now, a trillion still a lot of money, okay? That's still a lot of money. And in the absence of that tech spending, we would likely be in recession right now. Consumer spending has been flattish. Business investment outside of AI has been sluggish at best. Really, the only thing really driving the economy, really pushing up growth right now is this tech spending, is this massive amount of capital spending on AI infrastructure. Meanwhile, none of this is really making money. So the consulting company McKinsey recently did a study, and they found that 8 out of 10 companies are experimenting with AI. Well, great, they should. Why would you not use this tool? However, they also found that 8 out of 10 companies were seeing no benefit to the bottom line. They were actually getting no measurable impact from it. Now, don't just take McKinsey's word for it. Like, let's look at what the companies themselves are actually reporting. So last week, Salesforce had its quarterly earnings, and Salesforce is the premier provider of enterprise customer management software. If you've ever worked in sales, you've probably used Salesforce. They make a great product. They've also been pouring a ton of resources into AI, and in their last report, Wall Street was quite upset with them because they couldn't really pinpoint any benefit from it. It's a huge cost to them, but it wasn't really impacting their profit. So I know how this ends. I know I don't have to have a crystal ball. I don't have to have a fortune cookie. I don't have to be, some sort of genius here. I know how this ends because I've seen it before. What's going to happen is soon, one of the big boys, Microsoft, NVIDIA, I don't know, one of the big boys is going to have an earnings release that whiffs. They're going to report that, oh, growth didn't materialize like we thought it would. That, hyper growth we were seeing in AI, oh, it's slowing down. And then when that happens, that's when the questions are going to start. That's when Wall Street's going to start asking, okay, you've been spending hundreds of billions. We're actually approaching, cumulatively trillions of dollars on this infrastructure. And what benefit are we getting? Like, we're only seeing incremental improvement. Meanwhile, look over here in China. China is able to produce AI that's almost as good as ours at a fraction of the cost. We saw a sneak preview of this, by the way, back in January. DeepSeek, the Chinese AI bot that's very similar to ChatGPT, that came out in January, and it was almost as good. It wasn't as good. ChatGPT is still better. Grok is still better. The American AI models are still better, but it was awfully close, and it cost a fraction of what ours did. Now, if you're in the business of counting beans in corporate America, you have to be asking yourself, does it make sense to keep pouring just gargantuan sums of money to be a tiny bit better? Or can we save money, use these cheaper models, and we're done? We're off to the races. So that's when the bottom falls out. That's when there is a realization that, oh, yeah, we've overbuilt. Yeah, we have actually too many data centers. Yeah, we're not really using all this capacity. And I know this because I've seen it before. Let's go to the next slide here. You won't be able to read the name of the company unless you have really good vision. But you can see what happened here. The stock price absolutely collapsed from over $80 a share down to less than 10. And this was back in 2000. And 25 years later, it's still not back to its old peak. Now, what company is this? This is Cisco Systems. Oh yeah, Cisco Systems today seems like it's old tech. Who cares? But it wasn't old tech back in the 90s. This was the premier infrastructure company that made the internet possible. We would have never had an internet were it not for the switches and routers and just the plumbing, the plumbing of the internet that Cisco Systems built. And and by the way, their growth rates were every bit as impressive as the growth rates you see in the Mag 7 today and the big AI stocks today. They were growing their revenues by 40 and 50% a year in the late 90s. They couldn't build the equipment fast enough. It was flying off the shelf. And then what happened? It became overbuilt. The corporate America stopped buying as many switches because they already had more than they needed based on current data needs. And then the stock price cratered. Now, interestingly, their business setback was only about 2 years. In 2001 and 2002, their sales actually, they saw sales losses. But by 2003, they were already growing again and growing at a fairly handsome rate. Like, their business was actually strong from 2003 onward. But you would have never known that from looking at the share price. The share price was a fraction of what it had been just a few years before. And like I said, it's 25 years later and we're still waiting for new highs. Who knows? We may not live long enough to see new highs. So is this exactly what we see happening in the future? In the near future? It's not going to be exact. History never repeats itself exactly. But the Mark Twain quote, it rhymes. What we're seeing today is very reminiscent to what we saw about 25 years ago. And I remember 25 years ago, there were some graybeards who told me, "Oh, I remember the market of 1973, 1974." And I shook my head and thought, "Okay, yeah, you're crazy, old man." And now I'm the crazy old man telling this story. So it seems that everything does go in cycles here. Anyway, that's the macro environment we're in. Like this is the reality. This is the climate. What are we doing about it? Like how are we reacting to this? I told you we wanted to get in front of it. So what are we actually doing? So I'll tell you about that. But before I do, real quick, I do want to review our model, how it works, just our thought processes, because that becomes really relevant. Remember, our model that we use in the Blue Oak Capital Fund is based on money flows. We follow institutional money flows. We want to see where the big money, pension funds, sovereign wealth funds, endowments, we want to see where they're going. When the big money is buying, they don't buy it all in one day. They can't. They're too big for that. They have to average it in, right? And so we know when the big money is getting into the market, we know that we have a window of time where it's relatively low risk and a very high probability of success to be long, to have risk on. We know that. On the other side of that, we also know that when there is an absence of institutional money flow, we know that it's a higher risk time to be investing. The market might go higher, sure, but it's a higher risk time. That's not when we would ideally want to have exposure. Now, given the changes that we see, the biggest fundamental change that we've made is we now have the ability to go long or short. We have the ability to ride the market higher. If the market continues to blast off higher from here, great, we can participate in that. But if it then rolls over, as it did in 2000, then we can also make money to the downside. Before, our model was either, in the pool, out of the pool, right? Like risk on or risk off. So, but it was when we were in risk off mode, we weren't trading. We were sitting on our hands and we were just waiting, biding our time. Now we can be a bit more proactive and actually go short when the market's falling. So we can benefit from the upside and we can benefit from the downside. Let me also very quickly go over to kind of more technical details that under the hood changes we're making, and then I'm going to pass it on to Mario to let him go into more detail on it. But one of the fundamental problems we've had over the last, recently, is that we weren't getting enough trips to the plate. We weren't getting enough at-bats, so to speak. We weren't getting enough positive trade signals. We weren't getting enough risk-on signals. So to kind of use a baseball analogy, if you got Ted Williams on your team, you just want to get him up to the plate as much as possible because the numbers are in your favor. You want that guy in the batter's box as often as possible. You want him swinging because it's a numbers game. The more at-bats he gets, the more trips to the plate, the more times he's going to get on base. Well, our problem was we weren't getting enough at-bats. And we know why. It's because the narrowness of the market of late was hard for our model to interpret. Our model had never seen a market this narrow, and so it was kind of giving us a yellow light, right? So we've made a change. We've adjusted our money flow model to more heavily account for the inflows and outflows into the major names that are driving the index right now. The big tech stocks that are dominating it, we're more closely measuring that money flow. The second issue was, apart from not getting as many trips to the plate, we found that the pitches we were getting weren't that great either. And that comes down to the structure of the options market. So the way we executed our strategy before, we would get these signals, of course, but then once we would get the signals, we would execute it. And we would do that by selling options. We did that for a very good reason. The premiums we got on the options for years were juicy. They were fantastically juicy options. They were overpriced, so that gave us a really good opportunity to take the other side of that, to sell it. What's happened is the options market has changed. All of the trading volume has shifted to the ultra short-term options, which have become very popular in recent years. That's made the options that we used to sell comparatively, less juicy. We're not seeing the premium we used to before. So that left us with really three potential courses we could take. One is we could just take more risk. We could just sell more options. But that doesn't really work for me. Yeah, I'm looking to do this for the next 20, 30 years of my life. I'm not going to risk your capital, risk my capital, or blow up my career in order to chase returns in the short term. That's stupid. We're not going to do that. We're first and foremost, we protect capital. That's what we do. We're risk averse. The other option, of course, is we could just accept lower returns. Well, I'm not going to do that either because I have my money in this fund too. I need to generate a competitive return. That's non-negotiable. So that left, of course, the third option, which is we keep our model intact, but we change the way we execute it. So rather than trade the options, which are just not as profitable as they used to be, instead we're going to trade the underlying securities or futures that the options tracked. So in plain English, rather than trading for example, an option on S&P 500 or S&P 500 futures, we're going to trade the futures themselves, or perhaps an ETF that tracks the index. We're going to go more directional there. Now, this really just takes us back to our roots because Mario has been trading this. We're coming up on the 20-year anniversary of this model, by the way. Mario and I have been working together since 2018, but he and his team previously had been using this model long before I was in the picture. And like I said, we're coming up on the 20-year anniversary of that there. When they initially came out with this model, that's how it was. They traded the underlying securities. They switched to the options approach because it made sense. The market gave us a great opportunity. The yields were juicy, and so that made sense at the time. So the market has changed. We've changed with it. So with that said, I'm going to hand the baton to Mario now.
Thank you, Charles, and welcome to everyone. Like Charles mentioned, we are in a bubble, and we want to be ahead. This is the key of this presentation. Also, Charles mentioned that we are in a constant state of improvement. Like the model started in 2006. After the big explosion in volatility during the financial crisis, the model started trading options. And today, that's about 15 years later, we are again going back to the roots. So we're going to trade more tactical. And let me show you why. Here we have the major drops of the S&P 500 for the last 15 years. You see how fast they were recovered? COVID was 34% down, and it was recovered within a quarter. The last one was the Liberation Day, that was about 20% down, and the S&P 500 was able to recover it within a month. But history doesn't show like that. History in the S&P 500, we have two drops that both of them lasted a few years. A recurring quarters of drops after drop where the market sentiment shifted. We can see how long there were the drops from the dot-com and how long were the drops from the global financial crisis until they were recovered. There were prolonged phases of equity deleveraging. Normally, this time, we think this is approaching. And this, if we recapitulate, we only have two major changes in the system. So for me, let me put it in the picture. The S&P 500 today resembles the Nasdaq of the year 2000, mainly because of the heavy concentration in stocks. The Nasdaq, the drop in the Nasdaq was almost 15 years long. Right? It is true, it went down 80%, it recovered to minus 50%, and then it went down almost again to minus 80% with the global financial crisis. The last three drops, they were similar to the S&P 500, 33, 27, 28, and 23. And looking at the numbers, we realize, okay, this doesn't make sense. Why is the market so resilient? And we know is a strong growth from very good companies. But since 2022 to today, we have seen value and growth diverging. I want you to focus on the chart on the dotted points. So the green dots is the consensus for the earning per shares from 2026. And the pink is the 2027 earning per share consensus. You see in the growth stocks, they still continue to trend higher. In the value, they don't. 2022 was down, 2023 was down, 2024 was down, and that created divergence. So because we are always in a constant state of improvements, we said, okay, let's look at it, let's capitulate all the data we can measure and then take action. And it will happen. There is about risk management and going long and short. Like Charles mentioned, going short has the ability to capture the downturn if there is once the downturn produces. Going long has the ability of capture the upside if we do continue to go higher. The other major change or the other major data point that we use to be able to say, okay, we have to adapt, we have to move to the market, is because we cannot be complacent about protecting ourselves. We are in a bubble, and the easiest way to make money in the bubbles is to go long. But when we look at the data, how the volume in options, ETFs, and stocks has grown versus the S&P 500, we see how market participant hedges changed. On the charts on the left, we can see algorithms, computers, name it what you want. Every 50 minutes, they are trading. And in the other side of that spike in volume, there are institutions. It used to be, years ago, close to a decade, that if you wanted to hedge your exposure in the S&P 500, you have to go with a quarterly options or in a monthly options. So you have one chance a quarter or one chance a month. Now we have a chance every single day. So these have stopped the systematically overpriced options in the long term, in a month and in a quarter where we were very active. So let me focus on the basics of our system. So we can say that we are a trend follower. We have added new instruments. We have been trading S&P 500 and QQQ for about 20 years. The signals here in the gray color, we have the average signals we got for every year. And in the blue, we have the new model, the number average of entries that the model would trigger. Since 2022 to today, you see the slope of the gray line has been decreasing constantly. This is because the options are not overpriced like they used to be, and the way market participants are hedging differs from the way it used to be. However, we introduced new instruments. We have new sector trackers, currencies, gold, and dynamic entries, both long and exits. So now we will be adding gold, silver, consumer discretionary, the main ETFs that are driving the performance, but also those ETFs that are making the stock market more resilient, right? Real estate, utilities, healthcare, and so on. If we go back 25 years of data, we can see these are the drops of the different sectors we're trading. We can see how heavy it could be the selling on this instrument throughout the years. So we are thinking that once the market trades for multi-quarter and the deleveraging of the exposure in equity market starts, we can see again median values, for example, in the QQQ, the median value of the drawdown in the last 25 years was minus 40%, right? The S&P was minus 10. If you see the asterisks right now, all of them, or almost all of them, except consumer discretionary and real estate, are close to the highs. Energy is also a little lower, but all of them are trading at near the highest valuation of the last 25 years. For me, to change a model that had worked for 20 years and allow it to now go short is because we want to capture the opportunity that these instruments can give. So let me show you the evidence. Allow me to show the example of the S&P 500 this year. So the new model will be a par, even a little higher than the S&P 500 today. So we don't have an issue capturing the upside. But with the previous model, we had an issue capturing the downside because we would stay in cash when the risk of system trigger. Now, when the risk of system triggers, we will continue with the downturn, hoping that the prices can trade lower. The green arrows, sorry, no, there is no green arrows. The blue arrows indicate a trend along and entry signals long. So we want the market to trade higher. A red arrow indicates that a short signal. So we want this market to trade lower. And a white arrow indicates that we go into cash. So we started in the middle of January, we took a long. Then we changed to short around the third week of February, that we continue to profit until we have until we went into cash. You see, when the lower low of that resistance level didn't break, we went into cash. The liberation day happened 3 days later. The volume inflows, or actually the lack of volume inflows, money leaving the United States, was so large that it triggered our system to go short. We had a big spike, huge big spike, and triggered the system to decrease risk and look for longs position. And we took the long the day before the low. And this is the ability of this system. That long lasted from the beginning of April almost to the third week of August. With the options, we were restricted for a time period. So we would trade a month, or we would trade 90 days, or we would trade for a week. But once we took all the option premium that we collected, we could not continue trading that signal until we produce a new signal. So that's why it was so important to have the continuation of signals. So that signal lasted from the beginning of April to the end of August. Then it looked for a long, the selling pressure stopped, we went for a long, and now at the moment we are waiting for the continuation to the upside. And I think today we reach again new highs. So before I conclude, you that has been a while with us, understand we want to be ahead. And to be ahead is not to be complacent about our risk management. Is we are in a bubble, and the easiest way to act is when everyone is thinking outside and enjoying the view. So having said that, we welcome the opportunity to address your questions.